This is Mark Anthony with Mercury Time Price Analytics, and welcome to a very special video about our latest algorithm, the Saturn GT40 tick algorithm. Now, this is going to be a tutorial for our members, but we're going to put this out on public YouTube anyway. This is quite simply the most powerful algorithm that I believe exists anywhere. You know, we put this challenge out back in January that will go head-to-head with any algorithm, any black box system, commercial, institutional, or otherwise. Nobody's taken us up on that offer, and they're not going to because they'll get embarrassed. When you're building algorithms, let me take a step back. Let's talk about the trading dynamic of individual trader just using canned technical analysis tools versus the institutional algos, because there's been an evolution of what they're doing. You know, initially when the institutions were building algorithms, all they had to do is be better than you and me, the individual traders. But now you've got to a veritable arms race amongst the institutions with their various algorithms, because it's no longer about taking money from individual traders. They were able to do that a long time ago. Now it's about taking money from other institutional algorithms, being smarter, being faster, being craftier. What this algorithm does is it shows you exactly what the institutional algorithms are doing, where they're doing it, when they're doing it, at what price. When we design these, it's real important that we make the interface very, very simple. So you've got extraordinarily sophisticated math underlying this system, but it's very, very simple to use. This arms race between the algorithms, what they've done is take their basic original core set of algorithms. Then they build on that, and they come up with a second derivative of those algos, and then a third derivative, and a fourth derivative. And every time they add that additional derivative, the algorithms get more powerful and more accurate, because each additional layer of derivation provides another layer of confirmation. The additional more advanced pieces, the additional more advanced derivatives confirm themselves, and it gets very, very powerful when you start layering this math on top of itself. Now, before we get into that, the third and fourth derivatives here, just real basic concepts. I talk a lot about algorithmic clusters. You can see how all these algos come together. Now, these algos run on very, very different time cycles. You can see how wide apart they get at times. But right here, they cluster together. Fast impulse directional moves always emanate from these clusters. It doesn't mean that to have a fast move that you have to have these clusters. What I'm saying is, when you get them, you will always get a fast directional move, and you just go with whichever way it breaks out. So here you have one of these clusters, and it came after a sharp move lower. And you get a little move above the cluster, comes back, finds support at the cluster. You get a little bit of price moving up. You come back and you stop to the tick right here at this white line. You move up a little more, make a lower high, and this is where you get the bear trap, because when people see this lower high after seeing this move down, they're thinking that this lower high is going to do the same thing that this did. And all it does is come down here literally to the tick, to this orange trend algo, and then boom. And that's what the algos do. They bait you into jumping on the wrong side, because humans have this thing called recency bias. We see something happen, and then the next time we see something that closely resembles it, you know, we think it happened before, so it's going to happen again. And that's how these algos just, they crush you. Because if someone got short here thinking, well, this thing's moved a bunch, so, you know, let's just short it because you had a big move. Well, that means you've got stops above here. And then you've got people that see this move down, and they're shorting in here. And then you've got a third group of people that when they see this lower high, they're short too. And then what happens? All it does is come down to algorithmic support, and boom, you've got multiple bunches of traders that have their short stops run, and you get this. Okay. And over here, same thing. This orange algo, this is the primary trend algo. All right. So you lose the primary trend algo, you crash down through it here, you regain it, and then you find support at the primary algo there to the tick here. And then over here, well, now you break that primary algo again. You come down here to this algo. What a coincidence. It stops to the tick. You get a back test that fails and crashes right back through the trend, and then it's down. So let's move on. But I just wanted to show you some of the symmetry that you see in these algos when you start getting into second and third and fourth derivatives. All right, here's where you get into third derivatives. The sloping lines here are a second derivative algo. The third derivative is when you're looking at the peaks and the troughs and the crossovers of the algorithms themselves. That's your third derivative. Now, I didn't rehearse this video. We're going to do this live on the fly so I can share with you how easy it is to spot these. So let's take a look. All right. You got the peak here in this fast algo. Comes down here, and there's your little trough. All right. Comes back up. And when it breaks that trough, okay, boom. So you don't short it here. You short it right underneath that. Take a line and draw it underneath this little trough, which this line that's already on the chart. Well, I mean that's right there. So that's perfectly aligned. All right. So that's one example. We'll take this dashed white line here. You come up, you make a little tiny trough. You go higher. Take a line, a horizontal line, put it right under that. You get that break again. Oh, by the way, you also get a back test right up into the downsloping algo. But I don't want to get off track on anything other than these third and fourth derivatives. So I'll try and keep it to that topic. Now, you get a crossover here of the purple algo through that one. Now, take where these two algos intersect and do the same thing. Draw a horizontal line. That horizontal line comes in right here. I mean, forget about the fact for a moment that this bar found support right at that dashed line. What's more important is this spot here where these come together, and that's right at the low of these couple of bars here. So you take that line and you draw it across. Where does this thing break? When it comes down and it breaks that little spot there, which happens to be sitting right on top the peak of that dashed white line, and also right at the point they crossed over. So let's find another one. Let's see. Okay. Right down here at the peak the trough of the purple algo right there. Same thing. Breaks down. And again, I'm doing this on the fly to show you how easy this is, because these things are all over the chart. Let's take, all right, let's take this high right here. You can tie this back right to this spot right here where the purple algo crosses down through the orange one. Let's see. Now, let's take a fourth derivative. We'll take a trend line, and we'll draw the trend line from the point that the purple crosses through the white. And let's see, we'll take it, we'll draw this right down through where you get the next cluster. And where do you get your back test? Right there. Let's see. Let's move the chart forward just a little bit. Okay, here's another one. The point right here where the dashed white algo crosses through this secondary trend, primary trend algo, secondary trend, right here. So when you get this move back up, where does it stop? See that spot right there? Lines up this little shelf of price right here. Lines right up with it. Let's move this forward a little bit more. All right. So once again, when you get this move up here, where does it find support? Right where this crossover is. You can do this all over the chart. All right. Let's see. Let's find you another one. Now, back in here, this was the initial breakdown, taking the slope of, or this little trough in the white dashed oscillator. If you were to put a horizontal line underneath that, where does this entire structure find support? Same spot. That whole structure finds support there. Even had this trend oscillator not been there, same thing. So let's talk about this bottom down here. Let's see. All right, we'll take this little one right here. You have just a little peak up here, and then it comes back down. Take a horizontal line, lay it on top of that. That's where these two extension bars came up to. Little pullback, and they went through. Notice you've got another one of these clusters again. And so they're like slingshots. When price goes through these clusters, you get this move up, and where does this find support? Again, right here at that cluster, and then it takes off. Let's move this forward a little bit more, and we'll talk about this whole structure from here. All right. So we'll take this little peak right here, and when you draw it across, that's what gives this whole structure support. Where does this all start to break down? Breaks down when it loses that line. So peak of the purple right there. You get this move up and down and up again, and then it breaks hard when it ultimately breaks that spot right there. Take this crossover right here, draw the line right there. This whole structure right here breaks right at the spot. If you take where these cross over and you draw a line across, it's right there. All right, now let's take the peak of this white one. Lay a horizontal line on top of that. And again, that puts it right here. And you look at this a million ways. The reason you can look at this so many different ways is because every algorithm in this, the best way I can describe it is they're circular. They all tie into one another. They tie into themselves because they're based on price and time. So what this white dashed algo does over here vibrates off what it did here. And when this fails, the peak that it had over here, that's when the whole thing falls apart. So take this line from top of the white dashed algo, and right there is not only where it falls apart, but what happens again? You get these to cross over. The purple line comes down, tries to bounce, snugs right up into the bottom of the white line, and it fails. Right? Again, we're talking about putting a horizontal line sitting right above here. Take this thing across. Right there, that's where it fails again. Let's see. Take this spot here where purple crosses over white to the tick. That's where this runs into overhead resistance. So I'll put the crosshair right here, and then just look to the left, and you can see it's literally right on that spot. And you can do this over and over and over and over again. Everything is tied together. So let's take this spot right here where the purple crosses through the white. You have this move up, comes down, up again, And when it fails, you get this type of action. Now, look at how violent this gets. When you have these algos tied up together, look, they're either going to be strong support or strong resistance. So let's say, for example, you were short somewhere up in here. Price comes down to this. What do you do at that point? Well, you take partial profit. Let's say you're trading a 3 lot. And let's say you shorted at this XSV6 algo, which, oh, by the way, goes back to February 20th, which was the day the whole S&P futures broke down. 220 was when it broke down off that all-time futures high. So let's say you shorted up into this with a tight stop, a couple handles on the other side, and you nailed it, and now it's coming down. So you come down to this spot here, and this is where trade management comes into play, using these same metrics. So you're short up here, it comes down into where the two white algos intersect. So what do? Let's say you're trading a 3 lot. Take one of them off, and then you wait and you watch what happens. Can't get back above the purple algo, and it comes down. Now, when you see bars that do not pause at these algos, then you don't take any off. It wants to keep going, and it breaks through both of those. Let me show you a couple of more. I don't want to let this video run too long. It's already 16 minutes, and I was hoping to keep this to about 10. Take right here where the dashed white crosses through the solid white. It's right in here. Where does this bar come into resistance? Literally to the tick. I'm looking at this red bar right here. Literally to the tick where that crossed over. And then it fails a second time at that level, and then you get another fast move down. Let's see. Let's just do one or two more here. Right here again, you have these two white algos merged together. Now look over to the right of the screen. Can you see over here where this fails? Comes down, finds support, comes up, and fails. Now keep your eye trained on this spot right here, and we'll take the crosshair and put it right where these come together. Now look to your right. That's where it broke. You can do this over and over and over again, because you're literally getting into third and fourth derivatives of the algorithms. If you gave me nothing more than this one chart, forget about everything else. Forget about our matrix pivot and our long cycle matrix pivot, which runs on a chart that's over 2 hours per bar. You give me nothing but this. And with this algo, you don't have to make any decisions. And that's the cool thing about using algorithms. You don't have to make decisions. What you do need when you're trading with algorithms is you need patience. Because you're not sitting there deciding, should I take a trade? Should I not take a trade? You don't make that decision. You let the algorithm make that decision. Do you think the institutional algorithms, picture a big server sitting there? You think the algorithm's sitting there tossing a proverbial coin, and heads we go long, tails we go short? No. Those algorithms have to have mathematical confirmation. They don't do anything without it. So again, I'm going to repeat this for the third time, because there's an old adage, and I don't know who said it, so forgive me for not being able to properly attribute it. But there's an old trading adage that trading is you don't make money, and let me back up so I don't butcher this. In trading, you don't make money trading, you make money waiting. Think about that again. I guarantee you, if you look back at your trading account P&L, the days that you probably did the best were the days that you took the fewest trades. And that's what this whole game is about. So that is our Saturn GT40 tick algorithm. And by the way, there is nothing in here with the number 40. I was working on this for the last couple of weeks, and the whole idea about this was to make it very, very fast, very responsive, like a race car. And last night, when I was finishing this up, my wife and I sat down and watched Ford versus Ferrari. Great movie, by the way. So the Saturn part of it, the Saturn is a whole series of algorithms that we're developing. When we watched that movie, I thought, why not? Saturn GT40, bingo. I wish I could tell you the number 40 is in there so you could try and unscramble how this works. It's not. So we thank you very much for watching this video, whether you're one of our members or you're somebody watching this on YouTube. You can visit us and find out more at our website, mercurysignals.com, or you can send an email directly to me, Mark Anthony at mercurysignals.com, or on YouTube, it's at MC2085. That's the letters MC2085. As always, and I say this with absolute sincerity, if you have just taken 20 minutes of your time to watch this video, you are more a blessing to me than I can ever be to you. I thank you so much. And more than anything else, we wish all the best for you and your family. God bless you. God bless your family. We hope to see you again soon.